It. Let's get back to these markets here. Again, we got kind of red and green on the screen here. We're going to check in with Matthew Vegari, head of research at Clearwater Analytics. Matthew, talk to us about Clearwater Analytics. What do you guys do, and how does that inform your view of the market?
Yeah, so we're a leading investment management platform. We see 10 trillion in assets flowing through our system on a given day, and that runs the gamut from large corporates, think Fortune 100, to insurers, asset managers, and hedge funds. And I kind of get to parse through that data on an aggregated level to see how investors are positioning their portfolios.
And what are you seeing in terms of positioning this week? Because there's been no shortage of news flow, certainly when it comes to geopolitics.
Absolutely. Well, our client base tends to think not in week-to-week time horizons, but rather what I would say quarter-to-quarter. I'm not seeing anything that indicates a rapid change in strategy. What I am seeing, however, is that through the end of last year, the last few months, we're seeing more of a stabilization in duration exposure, and that doesn't matter if you're a corporate investing in the near end of the yield curve, or if you're an insurer investing in a longer term time horizon. Essentially, firms have been embracing fixed income, but after years of adding duration, 2024 and through much of 2025, we are seeing a stabilization. And I think it really mirrors the fact that you're not seeing that much movement in markets anymore with respect to the 10-year, and you're seeing volatility in Treasury futures at cyclical lows right now.
So do you feel like by looking at the funds flows that maybe people are taking risk off the table in 26 after the really strong returns as we've had over the last several years?
I think there was definitely a little bit of a pullback at the end of 2025. We saw a lot of doubling down on the AI trade, actually, in the second half of 2025. Not just firms capturing gains, but actually increasing their exposure pretty meaningfully. But that did slow in December, and I haven't seen a reacceleration yet in the new year.
I know that your clients, the folks that you monitor, are not reacting to day-to-day headlines, but surely what's happening in Venezuela does mean a sea change for U.S. energy and oil and access to oil. Do you see, where would that show up first if people were to start making changes to their positions?
I think the number one thing would be, how is that going to flow through to inflation? So if we saw a material rise in the amount of supply that the U.S. had, which would, let's say, depress the price of oil by $10 or $15. If that flows through to prices, we would see maybe a change in the Fed's reaction function, seeing a deflationary impulse in the economy. And that's when I would think that clients would really wind down their cash holdings, for example, if inflation was reined in a little bit.
Earlier in 2025, we saw movement of risk capital, stocks, bond markets out of the U.S. to rest of world, including and mainly European equities and things like that. How do those flows look these days?
So it's really interesting that you asked that. So I created a database last year to look at actually what were international investors doing. So we have, looking at 50 or 100 billion in AUM for a largely UK and European-based clients, trying to see, did they divest from Uncle Sam in the wake of Liberation Day? And I kind of went in with a little bit of a questioning mindset, but actually saw that there were outflows and divestment for a few months in the wake of Liberation Day. That reversed by September, and those flows have continued back into the U.S. heading into the new year. I think there was a belief that maybe the cycle was, ready for a recession, but the cycle is certainly not down for the count, and the international investment community definitely believes in U.S. assets right now.
What about private credit? Private credit has been having a moment for the last couple of years, but towards the end of last year, there were some concerns that cracks were starting to show, especially with unexpected bankruptcies of some companies like First Brands and Tricolor. How's that showing up right now? Have you seen much movement away from private credit?
No, in fact, we saw increased flows in December. I view the risks from private credit, particularly things like First Brands, as reasonably idiosyncratic. If you look at delinquencies just for small businesses, they remain pretty low. And if small businesses are doing pretty well, then large businesses that are handling larger amounts of capital are going to be doing well as well. So from my point of view, the private credit story is well underway, and we're not seeing divestment from that asset class.
How does the growth of ETFs impact kind of your business, looking at where the funds are flowing? Because it seems like all the dollars seem to be going to ETFs.
Yeah, I think for ETFs, there is definitely increased appetite particularly from institutional investors that may be stuck with mutual funds, maybe directly held stocks. We're still seeing continued flows into ETFs, and that's kind of an ongoing structural story.
All right. And when it comes to those ETFs, though, we're not looking. Are you looking at sectors? Are you looking at single stock leveraged ETFs? Because those have really taken off over the past year. They've become like the hottest launches, but it's very much geared towards a retail investor base. I wonder if there's any institutional interest in those kinds of products.
I think that our client base tends to play it a little bit safer than potentially the retail investor, and so I'm not seeing a material uptick in that type of ETF.
All right, Matthew, thank you so much. Appreciate it. Matthew Vegari, he is head of research at Clearwater Analytics. On a day when we've got some economic data here, Scar, that pretty benign. I mean, non-farm productivity